Blanche keeps hearing the same phrase everywhere. Put your emergency fund and even your regular savings in a high yield savings account. But what exactly does that mean? Is it an investment? Can she lose her money? And how is it different from the savings account that she already has? A high yield savings account is still a savings account. It is not a stock market investment, so its value does not rise and fall with the market. The main difference is that it usually pays more interest than a traditional savings account. Interest is money the bank or credit union pays Blanche for keeping her money there. The amount the account pays is shown as the APY, which stands for annual percentage yield. The APY tells Blanche approximately how much her money could earn over 1 year, including compound interest, if the rate and balance stayed the same. Compound interest means the bank pays you interest on what you've saved. Once that interest is added, you begin earning interest on the larger balance. Here's a simple example. Suppose Blanche has $1,000. In a savings account paying 0.01% APY, that money would earn about 10 cents in 1 year. At 4% APY, that same $1,000 would earn about $40. That's not enough to make Blanche rich, but if the money is going to sit in savings anyway, she would rather have it earning $40 than 10 cents. So why don't regular savings accounts pay more interest? One reason is that traditional banks may have the expense of operating physical branches and locations. But many high-yield savings accounts are offered by online banks with lower operating expenses, so they may be able to pay customers more interest. But Blanche still needs to research the details. A high APY does not necessarily make an account a good choice. First, she needs to check whether the rate is temporary or whether she has to maintain a certain balance to receive it. Here are 5 high-yield savings accounts that Blanche can research. These rates are accurate as of August 2026, but they can change. These are examples, not rankings or recommendations. Next, she should look for monthly fees. A $5 monthly fee could wipe out much of the interest she earns on her HYSA, or high yield savings account. She should also check how quickly she can reach her money if she needs it. If this is her emergency fund, she needs to know how long transfers take and whether the bank has its own withdrawal limits. She should also verify that the bank is FDIC insured. If she's using a federally insured credit union, she will look for the NCUA insurance. For most people, this means that up to $250,000 of their money at one bank is protected if that bank fails. If Blanche finds the account through a financial app, she shouldn't assume the app itself is a bank. She needs to check which insured bank or credit union is actually holding her money. And here is something else she needs to remember. The APY, which is annual percentage yield, can change. It may go up or down. A bank may offer one rate today and lower or raise it later. This is different from a certificate of deposit or a CD, which may lock in a fixed rate for a set period. A high-yield savings account works best for the money that Blanche wants to keep safe and accessible, such as her emergency fund or money she expects to need within the next few years. It is not a replacement for long-term investing. Blanche's money may grow more slowly in savings, but she is not putting her emergency fund in the stock market, where its value can drop right when she needs it. So, What is a high yield savings account? It's simply a savings account that pays a more competitive rate. Before Blanche opens one, she compares the APY, fees, minimum balance rules, access to her money, and federal deposit insurance. She isn't choosing an account just because the words high yield sound good. She is checking whether the account actually works for her. If you're building your emergency fund, you can download the free HYSA checklist linked below. Start small and keep going.